There is a proposed $2,400 annual increase for every Social Security SSI and SSDI recipient in America. And right now, in May 2026, this fight is happening in Congress as we speak. At the same time, there are 8 brand new confirmed changes that are already affecting your payments, your taxes, your work limits, and your retirement age this year. Some of these changes put more money in your pocket. Others quietly take money away. And most beneficiaries have no idea any of this is happening. I am Pension Secrets USA. And in the next few minutes, I am going to break down every single one of these 8 changes and tell you exactly where the $2,400 proposal stands right now in May 2026. Stay right here because missing even one of these updates could cost you hundreds of dollars this year. Let us start with the headline that everyone is talking about: the $2,400 annual increase for Social Security beneficiaries. Let me be completely honest with you. The way Pension Secrets USA always is, this $2,400 per year increase, which works out to about $200 more per month in your Social Security check, is a real legislative proposal. It is called the Social Security Expansion Act. It was formally reintroduced in Congress in February 2025 by Senator Bernie Sanders of Vermont and Senator Elizabeth Warren of Massachusetts, along with Representatives Jan Schakowsky and Val High in the House. This is not a rumor. This is not internet gossip. This is official legislation that has been introduced in both the Senate and the House of Representatives. And it has been analyzed and scored by the Social Security Administration's own chief actuary. Here is what the Social Security Expansion Act would actually do. It would increase benefits by an estimated $200 per month or $2,400 per year for virtually every current Social Security beneficiary. The way it achieves this is by changing the benefit calculation formula to count more of your lifetime income, especially for lower-income seniors. It would also change the COLA formula going forward, basing it on the Consumer Price Index for the elderly, called the CPIE, instead of the current formula, which critics say consistently underestimates how much inflation actually costs older Americans. Seniors spend more money on healthcare and housing than the average American worker. And the current COLA formula is built around what the average worker spends, not what a senior citizen spends. That difference has cost Social Security recipients real purchasing power every single year for decades. The Senior Citizens League has calculated that Social Security benefits have lost roughly 20% of their purchasing power since 2000, even with annual COLA adjustments. The Expansion Act would fix that formula permanently. How would all of this be paid for? The bill would extend the Social Security payroll tax to all income above $250,000 per year. Right now, a worker stops paying Social Security tax once their annual income exceeds $184,500. That means a billionaire who makes $30 million a year pays Social Security tax on only the first $180,500 of their income, exactly the same dollar amount as a middle-class worker earning $18,500. Senator Sanders has called this arrangement an absurdity, and a large number of Americans across party lines agree that it is unfair. The Social Security Expansion Act would close this loophole and use that revenue to both expand benefits and extend the Social Security Trust Fund solvency for the next 75 years. Now, here is the status of the bill as of May 2026. The Social Security Expansion Act has not been passed. It has not been signed into law. With Republicans currently controlling both the House and the Senate, and with the current administration's focus on cutting government spending rather than expanding it, the bill faces significant opposition in Congress. However, it is not dead. It has substantial public support. It has been formally reintroduced in this Congress, and the more the American public understands what is in it, the more pressure builds on lawmakers to act. At Pension Secrets USA, we will keep you updated every time there is a meaningful development on this legislation. The $2,400 per year is not in your check today, but the fight for it is very much alive. Now let us move on to the 8 confirmed changes that are already real, already law, and already affecting your Social Security, SSI, and SSDI right now in 2026. These are not proposals. These are facts. Change number 1 is the 2.8% COLA for 2026. This is the most important confirmed change for the year. Every Social Security beneficiary, every SSDI recipient, and every SSI recipient received a 2.8% increase in their monthly benefit starting January 2026. SSI recipients got their first boosted payment on December 31, 2025. because January 1st was a holiday. For the average retired worker, this increase means roughly $56 more per month, bringing the average retirement check from about $2015 to about $2,071. For SSDI recipients, the average monthly payment rose from $1.86 to approximately $1,630. For SSI, the maximum individual payment went from $967 to $994 per month. For SSI couples, the maximum went from $1,450 to $1,191 per month. And if you are receiving the maximum possible Social Security benefit at full retirement age, that maximum rose from $4,018 to $4,050 per month in 2026. These increases are automatic. You did not have to do anything to receive them. If you have not seen these new amounts in your payments since January, call the SSA immediately at 1-800-772-1213 and ask them to review your account. Change number 2 is the Medicare Part B premium increase. And this is the change that quietly eats into your COLA raise. The standard monthly Medicare Part B premium increased from $185 in 2025 to $22.90 in 2026. That is a $17.90 per month increase. For most Social Security beneficiaries, Medicare Part B premiums are automatically deducted from your monthly check. What this means in practice is that the average retiree's net increase after the COLA minus the Medicare premium hike is not $56 per month. It is only about $38 per month. The Medicare increase consumed roughly 32% of the average COLA raise before you ever touched a dollar of it. This is something the Social Security Administration does not highlight in bold letters, and it is exactly the reason so many seniors feel like the COLA never goes as far as they expect. If you do not have Medicare Part B deducted from your Social Security check, for example, if you are under 65, or if you pay Medicare separately, then your full $56 monthly increase applies to you. Change number 3 is the new senior tax deduction from the One Big Beautiful Bill Act. And this is one of the most significant tax changes for Social Security recipients in years. On July 4, 2025, President Trump signed this legislation into law. One of its key provisions is a new temporary deduction specifically for Americans who are 65 or older. For the tax years 2025 through 2028, seniors can now claim an additional deduction of $6,000 per individual or $12,000 for a married couple where both spouses are 65 or older. This deduction is available whether you take the standard deduction or itemize. To get the full amount, individual filers need a modified adjusted gross income of $75,000 or less, and married couples need a combined income of $150,000 or less. There is a phase-out that goes up to $175,000 for individuals and $250,000 for joint filers. What this deduction does in practical terms for Social Security recipients is reduce your total taxable income. And because Social Security benefits become taxable once your combined income crosses certain thresholds, reducing your taxable income can actually lower or eliminate the federal tax you owe on your Social Security payments. This is free money available to you right now if you are 65 or older and filing your taxes. Make sure your tax preparer or accountant knows about this provision, because not everyone in the tax community has caught up with this change yet. Change number 4 is the full retirement age reaching 67 for everyone born in 1960 or later. This is a landmark moment for Social Security. In November 2026, the full retirement age will officially reach 67 for people born in 1960 or after. This is the final step in a 42-year gradual process that began with the 1983 Social Security amendments. For 4 decades, the retirement age has been slowly climbing from 65 to 67. That process is now complete. Why does this matter? Because your full retirement age determines how much Social Security you collect. If you claim at 62, the earliest possible age, your benefit is permanently reduced compared to what you would get at your FRA. If you wait until age 70, your benefit is permanently increased. For people born in 1960 or later who have not yet claimed Social Security, your FRA is now 67. If you claim before 67, your monthly check will be reduced. If you wait past 67, each additional year up to age 70 adds about 8% to your lifetime benefit. This is one of the most powerful financial decisions any beneficiary can make. And knowing your FRA correctly in 2026 is absolutely critical. Change number 5 is the new earnings limit for people who work while collecting Social Security. Many Americans continue working after they start collecting Social Security, especially those who claim before reaching their full retirement age. The SSA applies an earnings test to these individuals, meaning, if you earn too much money from work, the SSA temporarily withholds a portion of your Social Security benefit. In 2026, the earnings limit for people who are below their full retirement age for the entire year is $24,180. For every $2 you earn above that threshold, the SSA withholds $1 in benefits. For people who will reach their full retirement age sometime during 2026, a higher limit applies $65,000 on 160. For every $3 earned above that limit, the SSA withholds $1, but only until the month you actually turn your FRA. Once you reach full retirement age, there is no earnings limit at all. You can earn any amount without your benefits being touched, and any benefits previously withheld under the earnings test are added back to your monthly check over time to make up the difference. So, if you are currently working and collecting Social Security, check these new thresholds carefully against your income to avoid getting surprised by a reduction. Change number 6 is the updated SSDI Substantial Gainful Activity Limit. For SSDI recipients specifically, the amount of money you are allowed to earn from work each month before the SSA considers you no longer disabled is called the Substantial Gainful Activity Threshold, or SGA. In 2026, the SGA limit for most SSDI recipients increased to $1,290 per month. That is up from $1,620 in 2025, a $70 per month increase for people receiving SSDI specifically because of blindness. The limit is higher at $230 per month in 2026, which is $130 more than the 2025 level of $2,700. If you earn less than your applicable SGA limit, your SSDI benefits are not affected. If you earn above it, the SSA may consider your disability to no longer qualify for full benefits. This limit increases every year with wage growth, and knowing the exact current number is essential for any SSDI recipient who is working or thinking about returning to work. Change number 7 is the increase in the Social Security taxable wage base. This change does not directly affect what beneficiaries receive in their monthly checks, but it is important for anyone who is still working and paying into the Social Security system. In 2026, the maximum amount of your work income that is subject to the 6.2% Social Security payroll tax increased from $176,100 to $184,500. If you earn above that amount, you stop paying Social Security tax on the excess. If you earn at or below $180 for $500, all of your wages are subject to the tax. For most middle-class workers and self-employed individuals, this means slightly more Social Security taxes being withheld from their paychecks in 2026, but it also means they are building slightly higher future Social Security benefits. The bigger picture reason this matters is that it helps fund the Social Security Trust Fund, which the SSA itself has projected could face depletion in the early 2030s if no legislative action is taken. Change number 8 is the new Social Security credits threshold and the Payroll Information Exchange Program. In 2026, the amount of income you must earn to receive one Social Security work credit increased to $1,290, up from $1,210 in 2025. You still earn a maximum of 4 credits per year, and you still need 40 total credits over your lifetime to qualify for Social Security retirement benefits. With the 2026 rate, you earn your 4 annual credits once your work income reaches $7,560 for the year. This change affects people who are still building their work history, including younger workers and people who work part-time. If you are close to qualifying for Social Security for the first time, make sure you are earning enough to accumulate your credits each year. Also under change number 8, the Payroll Information Exchange Program called PIIE, which the SSA launched in April 2025, is now fully operational in 2026. This voluntary system allows the SSA to receive your monthly wage data directly from your employer or payroll provider with your permission. For SSI and SSDI recipients who are working and required to report earnings monthly to the SSA, PIIE can handle that reporting automatically, eliminating the risk of forgetting to report and triggering an overpayment notice. To opt into PIIE, you fill out Form SSA 8240, available on the Forms page at ssa.gov. Participation is completely voluntary and free. Now, let us put this all together with the big picture that every Pension Secrets USA viewer needs to understand going into the rest of 2026. There are 2 competing forces at work in the Social Security system right now. On one side, you have confirmed increases the COLA, the updated work limits, the new senior tax deduction, and improved fraud protections. These are real, and they are helping millions of Americans right now. On the other side, you have real threats. The Medicare premium eating into your COLA, the proposed SSI household reporting burden that could affect recipients who live with family, the 100% overpayment clawback rule that can wipe out your entire monthly check if the SSA says you were overpaid, and the long-term solvency question hanging over the entire program. The $2,400 annual increase proposal represents a genuine solution to the gap between what Social Security pays and what seniors actually need to cover their real costs in today's economy. With housing costs up, with prescription drug prices continuing to rise, with grocery bills that look nothing like they did 5 years ago, the COLA formula is not keeping up for most recipients. The Senior Citizens League estimates that since 2000, a Social Security benefit that would have needed to increase by at least 40% just to keep pace with the actual costs older Americans face has only increased by about 20% in real purchasing power. That is a 20 percentage point gap that has been building silently for 2.5 decades. While the Social Security Expansion Act faces a tough road in the current Congress, the public pressure around this issue is growing. ARP surveys show that 77% of older Americans felt the 2026 COLA of 2.8% was not enough to help them keep up with rising costs. That is 3 out of 4 seniors saying clearly and loudly that they need more. At Pension Secrets USA, we believe in giving you the full truth, both the good news and the hard news, so you can plan your finances, make the right decisions, and advocate for yourself and your family. Here is what you need to do right now in May 2026. Check your January 2026 payment and confirm that your amount reflects the 2.8% COLA increase. If you are 65 or older, ask your tax preparer about the new $6,000 senior deduction from the One Big Beautiful Bill Act when you file your 2025 taxes. If you are working and collecting Social Security before your full retirement age, compare your income against the new 2026 earnings limits of $24,080 or $65,160 depending on your situation. If you receive SSDI and are working, confirm that your monthly earnings are below the new $1,690 SGAA limit. If you were born in 1960 or later and have not yet claimed Social Security, remember that your full retirement age is now 67. And if you want your voice heard on the $2,400 expansion proposal, contact your elected representatives. That is how legislation moves. At Pension Secrets USA, we exist so that you never have to figure out any of this alone. Every change, every proposal, every threat to your benefits, we track it, we translate it, and we bring it straight to you. If this video gave you information you needed today, please give it a thumbs up right now. It helps more Americans who need this channel find us. Hit subscribe so you never miss a critical update, and drop a comment below. Tell us how the 2026 COLA has been working out for you, or tell us what you think about the $2,400 proposal. Do you think Congress will pass it? We want to hear from you. The Pension Secrets USA community reads every single comment, and your voice shapes what we cover.